Hello and welcome to another brand new series of free video recordings of lessons. And today we are about to start accounting for IGCSE, GCSE, and O levels. Right. Accounting is such an interesting subject. It is more like math, it is a practical subject. So it is very interesting. And today I'm going to discuss in Unit 1 basic accounting system. Actually, accounting for the GCSE and IGCSE is a whole syllabus. I have actually classified into 14 units. Of that, the unit 1, the basics of accounting and double entry system and ledger accounts, and unit 2, the books of original entry, these two units can go into many different sections because, this has many different parts that we need to discuss. Apart from the first two, all the rest of the topics will be covered. Rest of the units will be covered in one video each. Right. Okay. So unit 1, the basics of accounting and double entry system and the ledger accounts. In this, we will just have an idea what is accounting and how accounting is used in business, right? Okay. Accounting is based on many different concepts. Actually, the accounting concepts, it's more like a theory. The concepts lesson will be the last one that we will be discussing. But first of all, we will take at least just one of the concept in accounting that's known as business entity concept, because whole of the accounting system is based on this. That's why I'm taking up this at the beginning itself. Right. What is this business entity concept is, you know, in accounting, we believe that the business is a separate entity or separate person. That means there is always an owner or a few owners. But what we, you know, assume is that owner is a separate individual and business is another individual. We give life to business in business. So hereafter, remember, in the next lessons to come, we will be saying us, we bought, we sold. What do we mean is we are not going to talk about the owner there. We mean about the business. Because we do not care what happens to the owner in accounting. We only care what happens to us as the business, right? Okay, so business entity concept simply tries to say that the business is a separate individual separated from the personal affairs of the owner. So because we believe that business is a separate entity, we believe something like this. What's that is, now owners are the people who invest money into the business. So because business is a separate unit, we assume that whatever the money the owner invests into the business, we think like the owner gives to the business, because we think that business is a separate person, isn't it? So we say whatever the money the owner gives into the business has to pay him back, because business is a separate person. I mean, why do we assume like that is, if you take, you know, the owners of businesses, what do they actually do is, now the business owners, they invest in money in a business and they want profit from the business. But, let's say, for example, someone ran a business for like invested, let's say, £10,000 into a business and ran this business for like 10 years. And overall, he has made a profit of £30,000. He just invested 10,000. He had made a profit of £30,000 over the next 10 years. But at the end of the 10 years, let's say the owner is tired of the business and he wants, to give up. Now, it doesn't mean that the owner gives up the business, just leaves the business and goes home, letting anybody take it. When the owner wants to give up, what does he want is, he wants the money that he had invested at the beginning. So it sounds like as if an owner of a business is treating like his business is an outsider. It's more like he is lending to the business. So he receives a profit every year. And then at the end of the, a certain period, he wants all the money that he has invested into the business. That's the truth. So that's why we, assume in accounting that the business is a separate person from the owner, and whatever the owner invests into the business will have to pay him back. For example, let's say the owner invests 10,000. That means business receives 10,000 from the owner, and business at the same time, the moment the owner invests 10,000 into the business, at that same moment, business becomes liable to the owner, that 10,000 pounds. This actually, so now you see, if you look at this, there was only one thing happen. Now, these things that happen in a business, in accounting, these are called transactions. So actually, there was just one transaction that occurred. What's that? The owner setting up a business by investing 10,000. But we realize two impacts or two effects of that. We realize that the owner gives 10,000 to the business. That means business, as a business, we don't care about the owner, like I said. So as a business, the business receives 10,000 in, and at the same time, the business become liable to the owner 10,000. So one transaction, there are two effects, and this is called dual aspect of business transaction. That means remember, every single transaction in a business has two effects, and that is what we call dual aspect. Whether you remember the words dual aspect or not, that doesn't matter. But just remember one thing, that every single transaction in a business that occurs, one transaction has two effects, right? So the accounting equation, right? The person who introduced the double entry bookkeeping, we call him, his name is Luca Pacioli. Luca Pacioli, actually, I mean, of course, you don't really have to remember the history of accounting or anything like that, but he introduced something called an equation for accounting, where overall a business always depends on this. That is, assets equals capital plus liabilities, we say. Right, okay, let's look at what are all these things. These are new for you, actually. Assets. Assets means anything that belongs to us. Us means whom? The business, right? So assets are those which belongs to the business. Like it can be money, it can be building, it can be equipment, machines, or the stock of goods. All of these are assets. But obviously, none of these assets were brought in by the business, because business is, a created person. We have just created business as a person. So business is actually something, whatever the business has, it was given by someone who, one person can be the owner. It is given by somebody else, maybe. Those are outsiders, not the owners, but the others. Now, for example, let's say a person may set up his own business, so he may invest 10,000 pounds into the business. But when he needs some more money, he wants to expand the business, he may ask some of his friends or bank to lend some money to be invested into the business. Now, here, owner invested money, 10,000 pounds, and also outsiders have lent money to the business. So whatever the business has, that is what we mean by assets. Whatever the business has, it was given by either owner, that's what we mean by capital, or it was given by the outsiders. We call it liabilities. So assets, the value of overall assets, let's say a business has building, materials, equipment, cash in hand, and a bank deposit, all that the business has worth, let's say, 100,000 pounds. Now, this 100,000 pounds worth of assets would have been given by its owner, maybe all £100 was invested by the owner, or maybe about 80,000 worth of these is given by the owner and 20,000 is given by the outsider. So that's what, so in that case, if the assets are 100,000, then capital will be 80,000 and liabilities will be 20,000. So always the accounting equation is true. That means the value of assets always equal to the amount of liabilities and capital. So as I said, assets are all the properties and possessions belonging to a business with a money value. So that can be premises like buildings, vehicles, machinery, equipment, fixtures and fittings, inventory. Inventory means the stock of goods that we have. These are the goods that we are dealing with, selling. Debtors, we call it trade receivable. That means these are people who owe us money. Maybe we have sold them goods on credit without taking cash, so they owe us money, or we have lent some money, cash at bank and cash in hand. So these are not all the examples, but most popular examples of assets, right? Next, capital. As I said, capital means this is the liability of the business to its owners. So that's the, liability of the business to its owner. I mean, that's the money the owner has invested in the business. That is what we mean by capital. And liabilities is the money that the others have lent to the business other than the owner. So there are some examples of liabilities that I have given here. It can be bank loans, bank overdraft. Bank overdraft is when we withdraw more money than what we have at bank. We will discuss each one of these. Creditors or trade receivables are those that, I'm sorry, trade payable, it has to be. Please bear in mind, it is not trade receivable, it has to be trade payable. That is the money that we have to pay. I'm sorry about the mistake there. This is the money that we have to pay that, because we have bought goods from someone on credit. And other receivables, once again, it has to be other payables because these are liabilities that we are talking about. So other payables are like, not because we owe, because we bought goods, maybe sometimes we might have, missed the payment of, electricity bill, gas bill, or something like that before the year ended. So we owe that to the electricity company. All right. Now let's talk about the business transactions, how the business transactions can affect the accounting equation. Right. Now we already said accounting equation is always true every moment in a business. It is true. That is, overall total of the assets belonging to a business is equal to the value of capital and liabilities. So when the business transactions take place, that means we said transactions like, investing money or whatever like that, whenever, maybe for a day there are 100 or 1,000 transactions, whenever the transactions take place, it is going to have effect on asset, liabilities, capital, all three, or at least one of these. So let's look at this. Some examples of business transactions, and let's see how it is going to affect the business's accounting equation, as we have asset equals capital plus liabilities. Okay. Mr. X, a person, started in a business with £10,000 by cash. Okay. Now X starts a business. So what happens when X starts a business? Now we are not worried about X, but we are worried about the business. Business, there wasn't a business before, now there's a business, and this business actually is receiving £10,000 in cash. So the business did not have anything before, but now the business has $10,000. So cash is an asset. So we have an asset called cash worth 10,000, but earlier the business didn't have anything, and at the same time the business did not owe anything to anybody. But now, simply because the business is taking the owner's money, the business becomes liable to its owner 10,000 pounds. The business will now owe 10,000 pounds to its owner. Right. So accounting equation is true. Asset side is 10,000 and liability side is 10,000. Right. Another transaction that's happening. Deposited $5,000 from the opening cash into a bank account. Okay. Now, earlier the business didn't have any money, right? So then the business started, business got 10,000 pounds, but in cash. The money was there in the drawer in the office. But now the business decides to open a bank account in the name of the business and deposit some money, $5,000, into the bank. So what happened was earlier there was an asset called cash, which was 10,000 pounds dollars, but out of that $10,000, 5,000 leaves to the bank. So now what happens is cash or cash in hand decreases from 10,000 to 5,000. And the balance 5,000 is deposited into the bank. Now, although the 5,000 is in the bank, that 5,000 also belongs to us, belongs to the business. It is at the bank, but it is our money. So that's also an asset. So cash 5,000, bank 5,000 now. Still the total assets are 10,000. And still, earlier we received 10,000 from the owner. We have not yet returned a penny out of it. So we still have assets being 10,000 and liabilities being also 10,000, right? Collectively, capital and liabilities are both called liabilities because both are liabilities. Both we owe. One, capital we owe to the owners, and liabilities means when we owe to the external parties. Okay. Bought a machine for $3,000 on credit from ABC PLC. Right. Now, already we have cash 5,000 and bank 5,000, and we owe that 10,000 to the owner because the owner is the one who had given that money, which we have split between cash and bank. But now, what are we doing is we are buying a new machine. Now, machine is also an asset. So when we buy a machine worth 3,000, what happens is we are receiving another machine for 3,000, but we are not paying cash. We are buying it on credit from ABC PLC. So when we buy something on credit, we buy and we receive the product, but we owe that person that money. So we owe, what do you call, ABC PLC, which is our liability. We call it accounts payable or creditors, 3,000. So now if you look at the asset side totals to 13,000, so as the other side, liabilities also. So accounting equation is true even on this day. Right. On the fourth day, let's say the business bought 2,000 worth of stock of inventory and paid by check. What do you mean by stock of inventories? Now see, equipment, vehicle, machines, all that maybe we are buying to use. But I mean, unless our business is selling equipment, unless our business is selling vehicles, or unless our business is selling machines, then those are for use. But let's say, for example, our business is about selling shirts. So the stock of shirts is what we mean by stock of inventory. So we bought $2,000 worth of stock of inventory and paid by check. So what happens is cash in hand remains the same, but cash at bank it was 5,000 before, but 2,000 out of which we are using. So cash at bank decreases to 3,000, and we already have a machine worth 3,000. And this time we are also receiving a stock of inventory, which is also an asset worth 2,000. There's no change to the liabilities side. We still owe the owner 10,000 and we still owe ABC PLC 3,000. So both the changes were on the asset side. Bank decreased and inventory increased. So the total assets and total liabilities remain the same here. Right. On the fifth day, we bought a motor van £3,000 and dollars and paid by cash. Okay. So this time what happens? Cash decreases from 5,000 to 2,000. And what happens is we are receiving a new asset called motor vehicles. So that increases. So once again, no change on the liability side, because what happens is van is an asset increases, cash is an asset decreases. So both the impact is on the asset side. Let's move on to another transaction. On the sixth day, sold $1,000 worth stock for 1,300 and received a check. Right. Now what happens is we sold £1,000 worth stock. Now, how much worth stock we had was we had £2,000 worth stock. Right. So of the £2,000 worth stock, we sold £1,000 worth stock. So stock of goods, stock in hand, decreases by 1,000. But actually, although it is worth 1,000, we sold it for 1,300 and received a check. So cash at bank will increase by 1,300. It was 3,000 before. Now cash at bank becomes 4,300. So cash at bank becomes 4,300 and stock of inventory becomes 1,000. So what happens is there is a difference of 300 here. Now what's the 300 is? It is the profit for the business. All right. So think what happens to profit. Right. So as you guessed it, the profit goes to the owner. So it hasn't, we have not yet given. So we owe that £300 to the owner. If you add the the left side or the asset side here, it adds up to 13,300 because the cash at bank increased by a 300 extra than the stock that we gave. That 300 should be given to the owner in terms of profit. So what happens is capital side will now become 10,300 and liabilities is 3,000. So altogether 13,300 even on that side. Right. On the 7th, sold another 1,000 worth stock of goods on credit to Peter. But this time we are selling it at the same price. That's why it doesn't say anything about the sales price. So what will happen is stock of goods becomes 0 now. Inventory becomes 0. Right. Now we sold it to Peter on credit. That means Peter has not given us money. So until Peter gives this £1,000, he becomes a debtor for us. So it sounds like we own Peter for £1,000. So debtors are also an asset, or accounts receivable or trade receivable is an asset. So in this case, the changes are both in asset. Stock of goods decreases, which is also an asset, and debtors increases, and that is also another asset. So no changes in the liabilities side total. Right. On the 8th, let's say, part of the amount owed to ABC PLC, we have settled it, paid. Now we owed ABC PLC a certain amount. I believe it was 3,000. So of that 3,000, we are paying part of that liability. So when we pay that 1,000, what happens is we are paying it by check. So the cash at bank decreases. It used to be, I think, 4,300. So now it decreases to 3,300. Right. And on the other hand, what happens is we owed the owner 10,000 his capital and 300 the profit, and we used to owe the liabilities was 3,000 to ABC PLC. But since now we are settling this 1,000, we owe them only 2,000 now. So the total liabilities becomes 12,300 as well as with the assets. Okay, let's look at another transaction. Received a check of 5,500 from Peter as a part payment of the amount owed by him. Right. So we received a check of £500 from Peter. So when we receive 500, because Peter owes us money, £1,000. When we receive the £500, our cash in hand, it's a check, cash at bank, will increase by 500. And at the same time, earlier we said Peter is a liability, is an asset for us. He owes, and we own him for 1,000. But now since he returns, he pays 500, he only owes us 500. So what happens is cash at bank increases by 500 and becomes 3,800, and debtors or trade receivables becomes 500 where it used to be 1,000 before. Right, since both the increase and decrease are both on the asset side, there's no difference in the total there. Total remains the same. Right, okay. Right, let's look at another transaction, maybe received a loan from bank. Right, now this time we are receiving a loan from bank for £3,000. So cash at bank will increase from 3,800 to 6,800. Right, now it is a loan. So loan means earlier we only owe to the owner and to ABC PLC. But now since we are taking a loan from the bank, we are also liable to the bank. So what happens here is total assets and total liabilities both will increase. So there will be a new total on either side. Right, I think this is the last transaction for this section. Owner introduced a further $3,000 in cash and $2,000 worth of personal equipment into the business. Right, now what we see here is that owner is introducing more capital. That's it. Owner is giving more cash, $3,000. So cash in hand was earlier 2,000, and now with that 3,000, we are having $5,000 worth cash. And the owner is also giving equipment into the business. So we receive and we have another asset called equipment, as you can see. Right, so we have an equipment worth 2,000. So the total assets are now 20,300, because it used to be 15,300, but now 5,000 extra capital is given by the owner. So earlier the owner's capital was 10,000, but now he invests in another 500 in two forms: cash 3,000 and personal equipment of his he gives into the business 2,000. So altogether he gives an extra 5,000. So his capital becomes 15,000, and the profit we still owe him 300, and we still owe ABC PLC £2,000, and bank we owe £3,000. Altogether, the total of assets and total of liabilities is 20,300. Right, I'm sorry, it's my bad. It's not the last slide. I think we have another one or two more. Right, okay. Bought stock of inventory for $2,000 on credit from XYZ Limited. Right, now I'm sure this is easier to understand because we have already done that. What happens when we buy inventory? When we are buying inventory, the inventory stock will increase. We had an inventory stock of just $0. But now when we buy 2,000 worth inventory, stock of inventory increases. So this leads to total assets to be 22,300. Where did we buy this inventory from? We bought it on credit from XYZ Limited. So since we bought it on credit, earlier we owed the bank, we owed the ABC, but now we also owe the XYZ Limited. So what happens is liability to XYZ Limited also increases. So by 2,000, so as you can see here, trade payables, ABC PLC is 2,000, XYZ Limited is 2,000. Altogether, the liability size also totals up to 22,300. Right. We have one more transaction. where the owner withdrew 500 from the business bank account for his personal use, right? Remember, at the very beginning itself, we said we assume that the business as a separate, entity, separate person. So whatever, happens to the business is the business that we mind. It's our business to mind, but not about the owner. Now, here what happens is owner is withdrawing $500, but from the business bank account, not from his personal account. And from the business bank account, not to be used in the business also, he is withdrawing it to be used for his personal use. So what happens is cash at bank will decrease by 500, and since the owner took that money, so total assets become 21,800. Since the owner took 500 from the business, we call it drawings. Drawings is when the owner takes money, his capital decreases because we owed the owner 15,000 earlier, but now what happens is we owe 500 less because he has taken 500 from the business, from us. So therefore, the total of the liability side also adds up to 21,800. Right. Okay. So I believe that you must now have a very good understanding of business transactions. Right. One of the most important things of accounting is when I explain you the next topic, I will explain you something called the double entry system. Now, looking at this, please do not think that this is what is accounting. This is the way we record the business transactions. No. What I did in this lesson was to make you understand the dual aspect, to make you understand what happens because of transaction. One thing increases, another one also may increase, one increase, another decrease, and so on. The two effects of each transaction. To give you that is what I explained you. But next lesson, we will talk about double entry system and how to record in accounts. That's where we will be talking about accounts. We call it ledger accounts. Okay. But most importantly, you need to have about 2 or 3 skills to, be greatly successful in account. One is common sense. Common sense means, what I mean is the common sense to understand, what are the two effects of business transactions. That is, when one transaction occurs, let's say, for example, one transaction here is owner withdrew 500 from the business bank account. That's just one transaction. But there were two effects. One effect was cash at bank decreased by 500, and other effect was capital of the owner decreased by 500. So every transaction has two effects. You need to understand both these two effects, and then you will be able to record these things successfully in accounts with the double entry system in ledger accounts that we will discuss in the next lesson. All right, I'll see you again in another video. Until then, take care and goodbye.